Hello and welcome to The Pitch, brought to you by Livewire Markets. I'm Ali Selby and it's incredibly volatile out there at the moment. So to help you take a longer term view, we're joined by TMS Capital's Ben Clark for 10 stocks for the bottom drawer for the next 10 years. It's going to be a really good episode. Thank you so much for coming on the show, Ben.
You're welcome. I'm hoping I can remember all 10, but we'll get there.
What are some of the important factors you think investors should take in mind when trying to invest over a 10-year time horizon?
It's sort of interesting because I think it's the same as a short-term time horizon, but if you are truly buying a business and you thought, I'm not going to look at that share price for the next 10 years, it probably adds some weight. Number one's got to be balance sheet. You've got to have a business that can't blow itself up because there's a shock to its industry, there's a shock to the market, to the economy. Over a 10-year period, that's probably a reasonable chance to happen. And you need a company that can cycle through that and hopefully even take advantage of it. Number two, moat is such an often used word, it almost seems a bit passé, but it applies. And maybe the best way to think about a moat in this context is a business that can't be disrupted, because that, with the launch of AI and the change that is coming everywhere, is a real threat to a lot of businesses. So you want to think about a business that will still be entrenched in another decade's time. Management, I think it's always important, but you want a management team. The reason why this is interesting is because really good managers will be thinking 10 years ahead. They won't be thinking about when they're going to bail out in 2 or 3 or 4 years and where they're trying to get the stock price to then. You want a company that's making decisions in long-term shareholders' interests. And then I think structural tailwinds are always something I come back to. Doesn't necessarily mean you'll get long-term earnings growth, but if you've got good management, a good balance sheet, and you're operating in an industry that is forecast to grow significantly, you've got a big head start.
Let's start with moats first. Are there 3 businesses that come to mind that have really strong moats on the ASX?
Yeah, so I'm trying to pick out a bit of an eclectic mix here and not go all in one thematic. So I'll start with WiseTech. And that's kind of an interesting one because on the outside it doesn't look like they have much of a moat, but the moat is the hundreds of millions of dollars of technology investment they've spent building out CargoWise. And as FedEx and Kuehne + Nagel and more of these companies give up on their internal platforms and move on to CargoWise, it's creating this network effect which is pulling other businesses onto it. The thing with WiseTech is they don't have a competitor. So the competitor is these companies choosing to go back and try and do it themselves again, which is almost inconceivable. So for me, that's a big moat. Transurban's another one. No one is going to go and build an Eastern distributor next to the Eastern distributor. They have a monopoly, they have a very wide moat. I think that's one we can plainly see. But also the moat for growth is every time the New South Wales, the Queensland government announces a tender for a new toll road, they can bid on more competitive terms because they get this network effect from the linking in of cars from their existing toll roads. So that's a pretty powerful positive that they've got going. And then Wesfarmers, I think, is a third one. The moat of Bunnings, which is 70% of group earnings, is that the sites in inner city places close to very highly populated people are incredibly rare. So it's almost, again, impossible to see a second player coming in. We saw Masters tried. I think that's created an even bigger moat because everyone's looked, if Masters Woolworths can't do it, who's got a chance and who's got the deep pockets to fund it? So I think there's a big moat in Wesies.
Let's move on to businesses with awesome management teams. Does it have to be a founder-led CEO?
I think it's a massive help. The evidence is undeniable. I know you've done a lot of analysis on this with other guests. Founder-led businesses do outperform over the long term, so I think it really helps. So if I'm picking 3 there, all 3 effectively are founders. I'll start with Reece, which was started by the Wilson family many decades ago, and Peter Wilson is now managing the business. I think he's done an incredible job, but a very patient job in rolling out Morsco, which is now being rebranded to Reece, into the United States. Like an anecdote I heard on an earnings call, was when he spoke about flying over to Perth and going and staying with John Gillam for 5 days, who was the CEO of Bunnings and who unfortunately rolled out into the UK. And he said, I went over there just to understand what went wrong, what John would do again, it's that kind of effort that founders will go to try and make sure that the business is still going to stay on for the next generation. So I think they've done an incredible job. Goodman Group would be my second one. Greg Goodman achieved a lot. One thing is, like, investors all make a lot of mistakes, but you learn from your mistakes, and that's what makes a better investor down the track. And I think, if you look back at the GFC where Macquarie Goodman nearly went under, one lesson I think Greg took out of that was never let my balance sheet be put into doubt again. And so we go into this downturn in the REIT sector. Goodman's got 5% gearing on balance sheet, look through I think of 9. So that's the reason it's held up so well, because he's seen what's happened in the past, he's gone through that, and he's thinking about the long term, not trying to spice up returns in the short term. And then Macquarie. Now Macquarie's an interesting one because strictly it's not a founder-led business, but when you look at the last 2 CEOs, they have had incredible personal wealth in Macquarie shares. So Shamira's openly, I think, spoken about never having sold a Macquarie share. And Nicholas Moore, I think, was reported to have about $500 million in Macquarie shares when he retired. And Macquarie, to me, has been a best-in-class company at passing on the baton to the next leader, very long stints at CEO level, and then building out a team below where there's multiple candidates that could take that next job. And the other thing is the remuneration structure at Macquarie. You can't get a bonus, dump your shares and walk away. It doesn't work like that. You have to think about what the long-term outlook for the business is, because you're not necessarily able to sell your shares for the long term. So that's a third one.
You also talked about businesses with structural tailwinds as well as rock-solid balance sheets being really important when assessing businesses over the long term and short term.
Yep.
Are there any ASX-listed businesses you want to call out there?
Yeah, okay, so let's start at the top again. CSL, well-loved, but for all the right reasons. There's an undeniable structural tailwind in that sector. They're going to sell a lot more blood and plasma to billions of people in coming years. They've got an incredible R&D pipeline that's looking at new areas, and it's hard to go past the fact that if they can execute well, particularly on vitals, a few question marks I think at the moment, but if they can get those margins back to 2019 levels, the next decade's looking very good for CSL. REA, which I think is a bit of a play on the rising population as well that we're seeing in this country. It's just inevitable to me that there's going to be a lot more dwellings over the next decade than there are today. And if there's more units, houses, townhouses, whatever, there's going to be more transacting of assets every year on year. It's not going to be, of course, a linear growth. There'll be cycles. All of these businesses will have cycles through a decade. But if you've got more dwellings, there's going to be more turnover. And then over the long term, we should also see rising house prices in Australia. And if we see rising house prices, the algorithms that tie what REA charge you to advertise your property are kind of linked to the price that you're hoping to get for it. So that obviously will go up as well. So you've got growth on growth in REA. A third one, a bit unusual, Auckland Airport. Aside from the pandemic, one of the greatest structural tailwinds is global travel. As people get wealthier, they tend to travel more. And the Chinese, I think at one stage only had less than 10% of the population had a passport. So still, India will be another big nation that starts to travel. AIA has an incredible structural tailwind, because if you want to go to New Zealand, you only have one airport to choose to go through, which is Auckland. There are some flights from Sydney to Queenstown, but they own a portion of Queenstown as well. If you want to fly to Sydney, you can fly direct into Brisbane, Melbourne, Sydney, Gold Coast, Perth. But if you want to go to New Zealand, that is the gateway. And so to me, you've got, I think over the next 10 years, you'll have growth on growth on growth every year of the number of people travelling through the airport. You'll then have the growth of what they're charging you on a ticket price, which is regulated, but it will continue to grow up. And then you will also have, higher prices for rent, lounges, car parking, all of the ways that they can flex the money out of the asset. So that's got a big structural tailwind.
Okay, Ben, you talked about a lot of stocks today. We're very grateful for you sharing your ideas. I want to know, is there a stock, a holy grail stock, if you will, that has all those factors that you would back over the next 10 years?
Yeah, I'd say I actually reckon when I was going through the list, there's quite a few of those stocks that meet all three criteria. But to pick one maybe a bit out of left field, I'd go for Brickworks. Now, Brickworks, let's start with management. Lindsay Partridge has been there for, I think, nearly 2 decades now. And he's done an extraordinary job at growing that business from basically a brick producer to something now that's much more multifaceted. And then you've got Rob Milner as chairman of the company and the largest shareholder, the Milner family, who truly are making decisions on generational timeframes. So that's a big tick. Structural tailwind. The engine of the earnings business for Brickworks is actually the industrial property trust that they've got with Goodman. And as Sydney and Melbourne and the cities down the East Coast in particular continue to grow, they've got this huge land bank that they will continue to develop to build and own and operate these industrial properties. And as we all shop online and companies need to get closer to population centres, it's really hard to see. Again, there'll be cycles up and down over the decade, but it's hard to see that the rents from these assets won't continue to go up and that the valuation of the assets won't continue to go up. And then you've got the Soul Patts machine feeding a dividend into Brickworks every year, and that's more linked to what markets. Soul Patts is becoming almost like an investment house these days. And you've got to think, over a 10-year period, you get rising asset prices, and they're getting into some pretty interesting areas in alternatives and credit and stuff like that. And that's very well managed by Todd Barlow, who's done a superb job. So Brickworks, you've got the moat. And the moat in particular with industrial is you can't go and replicate the land bank of what they have. The building products business is going to be powered by the land bank that they have, and the mine where they can mine clay out of, close to consumers and lowest cost producers. And there won't be another player, I think, come into that market. So that's one that ticks all the boxes for me.
Okay, well, thank you so much for coming on the pitch today, Ben. Really enjoyed this chat.
Thanks.
If you enjoyed that too, don't forget to subscribe to Livewire's YouTube channel. We've got so much great content just like this coming every single week.